Welcome to part 2 of my presentation, Building Wealth and Living Off the Nestegg via Passive Income from Equities. I'm going to continue under the assumption that you have gone through part 1. In this presentation, I'll talk about why you can't time the market, why staying in the market is essential because most growth comes in spurts. And I'll also cover the three major indexes that I talked to you about, of which two are crucial for investors, the S&P 500 and the NASDAQ 100. You might recall in part 1 me talking about how important it is to play the long game and why equity investments should not be made, in my view, for a period of less than 5 years. And I'm going to try to explain the data to you so you get a sense for where I'm coming from and the basis for me to say what I've been saying. So typically, if you look at the 1-day investment period, like if you bought, let's say, the S&P 500 ETF, on any random day if you bought it, there's a 53% chance that it would be of higher value tomorrow than it is today. If you held it for 5 days, there's a 57% chance. And just as a comparison basis, most casinos are operating below this percentage and consistently making money. So these are not terrible odds. They're not great, but they're not terrible. But once you get to 1 year, the odds are about 75% in your favor. Once you get to 5 years, 88%. 15 years, 97%, and 20 years is pretty much a slam dunk that you will have a positive rate of return. So this is why it's important not to panic and sell your investments, equity investments in particular, just because of volatility, because these returns, the highest returns, are coupled with dealing with volatility. Now what happens is that most of the media have no choice but to report on the day-to-day tactical news, right? So if you're CNBC, you have to fill up a certain number of hours in the day. If you're a magazine or the Wall Street Journal, you have no alternative but to report on all the goings on of today. And this is tactical information, right? If you play the strategic game, you can simply ignore the day-to-day noise. And my philosophy is once I buy, I'm never going to sell. And certainly my window is going to be about 5 years or so. So this is an advantage that amateur investors have, because we don't have to report to a board. We don't have to report to a committee. We don't have to describe all our decisions, maybe other than to our spouse. But typically, if you just hold and buy, these are the percentage odds with you. This is in marked contrast to professionals, where every 3 months they have to write reports and explain to the investors why the market has gone down by 4 or 5%. And the investors lots of times don't understand why that is. And so in many cases, fund managers do engage in activities which are harmful to the long run, simply to kind of quell short-term fires, short-term troubles, and so on and so forth. And we don't have that problem as amateur individual investors, right? So I love this quote from Warren Buffett where he says, the stock market is a device for transferring money from the impatient to the patient. And he carries on in a different quote to say, from the active to the inactive. Ben Carlson says that the only dumb money is those investors who assume there's an easy money available in the short run. It doesn't exist. Having addressed the importance of long-term investments, right, 5 years plus, let's talk about staying fully invested, market timing. So market timing basically means that you're making selling and buying decisions based on where you think the market is going to go. And I'm going to try to show you data that pretty much tells you that it's a game that you cannot win. I probably have at least 4 or 5 studies, and I'm only going to share one with you, which pretty much say the same thing, right? The impact of being out of the market. So this was just one study done by JP Morgan, and they looked at the returns of the S&P 500 for the period January 2nd, 2001 through December 31st, 2020, right? So it's 20 full years. And the initial investment was 10,000. If you just simply bought it and did nothing else on January 2nd, 2001, you had about $42,000. And that's an annualized rate of return of 7.47 at the lower end of what the S&P 500 does, but yet you got a quadruple. If you missed just the 10 best days, you still had a positive return, but less than half, right? So 3.35%. And once you miss the best 30 days, you actually had negative returns. Now the thing to remember about these days are they're not consecutive days. So it's not like you missed a month, right? It's 30 random days when the market goes up. So the takeaway here is that the market moves up, and it moves up in rather sudden spurts. And when you miss it, it's very, very difficult to get back into it. So making buying and selling decisions is virtually impossible. The other thing that's interesting is that many of the best days occur fairly soon, within 2 weeks, within a month of some of the worst periods of investing, right? So it's not even like you can come up with some kind of algorithm where you can make buy and sell decisions. That doesn't mean that people are not selling you expensive newsletters and services claiming that they can, but the chances of any of them being correct are rather low given this data. If you invest for the long term, like we talked about a couple of slides back, and don't market time, then you might allow compounding to show you its magic. The way compounding works is, I'll walk you through the formula in just a second, but every 7 years, the market roughly doubles. You can't take it 100% to the bank, but in the long run, that's about the case. And the way it works is $1 becomes $2, $2 becomes $4, $4 becomes $8, $8 becomes $16. So in my case, I had, let's say, a 30-year career. Over 28 years, the very first dollar I put in had, under this model, gone up to about 16 or so. Many of the years that I worked, the market returns were a tad higher. So I probably did better in that sense. But then I also bought individual stocks, so I was sub the S&P 500. So I probably did worse on that portion, and I probably averaged and probably got the benefit of this, right? So the way compounding works is you must understand the rule of 72. So the years to double is 72 divided by the expected rate of return. So if the expected rate of return is 10%, which is what I have used in this example, it would take 7 years to double. So is 10% a fair planning number? And if you, from Investopedia, I found that for the period 1957, when the S&P 500 index concept first came into being, through the end of last year, it was about 10.26%. In my view, whenever I talk to people, whenever I do my own planning, I always look at a range in the range of between 8 to 12%. And if I can make the numbers work at 8%, then I feel like I have a little bit of a buffer. So this is how compounding works. Compounding also works in the negative. So if you borrow money and you pay interest, you're getting the opposite of compounding, or rather, compounding is working against you. Having discussed equities, let's take a look at the 60-40 portfolio. As I had mentioned at the very beginning of part 1, 60 means 60% equities, 40 means 40% bonds. This is what almost any professional advisor would recommend. So the way if you want to look at portfolio performance, I got this data from the period 1926 to 2021. In many ways, I don't like it when it's that long a period because so many things have happened. But the data is fairly compelling. If you had a 100% stock portfolio, and as a reminder, my entire investment strategy from day one when I was 24 years old till today, I'm 65, has been 100% stocks. That has annualized about 12.3%. And the 60-40 has annualized 9.9%. In my view, that certainly seems like a viable strategy. And so I consider both of those to be viable. The thing that you're giving up is volatility. We'll come to that in just a second. So what does 9.9% versus 12.3% look like, right? So over 30 years, ending in 2021, in this particular example, you would have had 96,000 versus 196,000. So these small annualized percentages, because of compounding, have enormous impact on outcomes. So that is the reason why I have a 100% stock portfolio. I'm trying to get as much of that extra 100,000 difference uh, that I can while dealing with volatility, right? So a measure of volatility is the standard deviation, how much on average the two combinations have deviated. And you can see that the 60-40 is about more than a third less than the 100% equity portfolio. If, like me, you don't give a darn about volatility because you know in the long run you're going to come out ahead, then it's a nebulous or an ephemeral concept. It doesn't have real life impact. If you have concerns and you get worried at seeing, let's say, $1 million portfolio go down to 840,000, if that gives you tremendous amount of concern, then a case could be made that, you know, a 60-40 or a 50-50 or some combination less than 100% equities is probably the right thing to do. Because understanding the price for getting equity-like returns is so important, I want to continue talking a little bit more about volatility. Um, One of the things that Morgan Housel says is that market returns are never free and never will be. They demand you pay a price like any other product, and in this case, it means dealing with the emotional feelings that you have to deal with when your portfolio takes a 40% plunge, 49% plunge. That will happen if you have heavily invested in the S&P 500. So let's just talk about just a short period, right? 2010 through a couple of weeks ago. This is the chart that shows the S&P 500. And because it's a shorter period, you can see the fairly sharp drops, right? So one of the drops you'll see is in very early 2020. And like in March of 2020, when COVID was hitting, the market kept going down, down, down. And I remember, for example, being on we set up a conference call between one of my brothers and a friend of mine, and the three of us pretty much spent 2 to 3 hours just buying. And even as we were buying stuff, the market kept going down. I found out later that close friends of mine was selling on the exact same day. So same event, two very different reactions. And in this case, as I kind of expected, and as I will continue to expect, the market came back in the case of COVID much faster than I could have imagined. I was prepared for an 18-month to 3-year ordeal, if you will. So anyway, that's basically what I wanted to share. In the long run, as you can see, it starts off low, and over a period of time, with enormous ups and downs, it ends up higher. To bring it all together, I wanted to just explain once and for all why I'm comfortable with a 100% equity portfolio. Very early on in my investing career, I was very fortunate to get a chance to read Jeremy Siegel's book. At that time, I was and I still am interested in dividend paying companies, and that's kind of what drew me to his initial work. But the thing that he pointed out that was counterintuitive was that over a longer horizon, a portfolio of stocks is actually less risky than bonds, even though the reverse is true over the short run. So when I looked at the data that I showed you a few slides back about the near certainty of positive returns once you get, beyond 5 years into 10, 15, 20 years, it made a tremendous amount of sense to me and gave me enormous comfort in holding a 100% equity portfolio. And basically the bottom line that I've emphasized to myself and when I have conversations about investing is that if you shun stocks because of short-term volatility, you may be sacrificing much higher returns. And as I showed you in the previous slide, that difference of 100,000, right, between a 60-40 portfolio and a 100,000 and 100% equity portfolio. I like the odds at 20 years, 100%. It's all about odds. So in this business, just like in life, right? In life, you can do all the right stuff, go to school, make all the right decisions, and your career still may not work out. There are all kinds of things beyond your control. Same thing here. There are no guarantees, unless, of course, they come from people with the first name Bernie and last name Madoff. In fact, run for the hills if somebody tells you that they can make money consistently, or rather equity-like money returns on a very predictable basis. That's a clear sign that they don't understand how the market works. The best someone can say is if you hold on for long periods of time, you'll get equity-like returns. Let's transition to discussing indexes. If you understand how some of these key indexes work, especially the S&P 500, I'm hoping that it gives you a tremendous amount of confidence in making it a somewhat significant portion of your portfolio. And I want to be very clear about the risks with the index and the details about the index and obviously the returns from the index. So in my view, the S&P 500 is market wisdom at work. And the reason for it is that it's market cap based. And what that means is as companies become more successful, as investors bid up Amazon, Nvidia, Apple, whatever, they become more valuable and they move into the S&P 500, and the companies less popular on the way out drop out automatically. So that's what I mean by market wisdom at work. The first ETF that was based on the index was SPY. It came out in 1993 and had become 152,000 30 years later by the end of 2023. So it's a 15x return. And just as an aside, SPY is probably one of the more expensive ETFs you can buy that mirror the 500 index. There are others that are cheaper like IVV and VOO and so on. So let's talk about the index in a little bit more detail. First, it covers all 11 sectors. So there's diversification. Its valuation is 75% of the US market cap and 40% of the global market cap. 40% plus of the revenues by these 500 to 503 companies that make up the index come from overseas. So something to keep in mind, and it has certainly influenced my international allocation because these returns are coming from overseas. And even better, they are coming in dollar denominated terms, so I don't have to deal with currency risk with S&P 500 companies. As I mentioned previously, 4% of the companies in the S&P 500 provide most of the returns. This was the outcome of a study done by Henrik Bessembinder from Arizona State. It was very compelling and makes one of the strongest cases for owning the entire index because these companies change and they can change very rapidly. As an individual investor with no unique knowledge, it's very difficult for you to know about these companies in advance. Some of the rules the key rules regarding how a company gets into the index. One I've already covered. It's based on market cap size. So the larger ones get into the index, the smaller ones don't, they drop out automatically. One rule that I like is the financial performance one, where the last 4 quarters must demonstrate positive net income. So these 500 or so companies all have positive net income cumulatively over the last 4 years. The sector representation I've already talked about, so it's diversified in that sense. And because of the market cap, typically these companies are able to, of course, meet trading volume liquidity criteria. One important thing to understand is that there's concentration in the S&P 500. Is nowhere near the concentration of the NASDAQ 100, but there is concentration. And you can see for yourself that Apple and Microsoft alone, just 2 companies, make up over 13%. This data is a few weeks old, but directionally you get the idea. The other important thing is the brilliance of it, right? Or rather the brilliance of the marketplace. Apple joined the index very early, right? And so did Microsoft, 1994. Take NVIDIA, the current darling, if you will. I'm hoping that it doesn't lead to a lot of people losing money, but it joined the index as early as 2001. So if you own the index, you went along for most of the ride. So again, great companies are added automatically because it's market cap based. Index is concentrated. It's a feature, not a bug, because as companies get more and more successful, they take up larger and larger portion of the index. As a just a reminder, it was mentioned the index was established in 57. The first ETF came out in 1993. And interestingly, and I don't personally know how to think about it, but later on I will tell you an action that I intend to take or recommend to people. But there is one equally weighted ETF that is available on the S&P 500 called RSP. I think it's from Invesco. And here's the thing that I can't fully wrap my head around. It matches the S&P 500 performance over the long term. And I will give more data on that when I do the presentation just on S&P 500. And there is a very clear kind of outcome and decision that one can make as an investor based on what I just shared. And I'll share that a bit later. Let's talk about the second index, second of 3 that I was going to cover, the NASDAQ 100. There are at least 2 ETFs that I'm aware of, QQQ, which is the old standby, and QQQM, which is about 25% cheaper. So this index consists of the 100 largest companies traded on the NASDAQ index, or rather the NASDAQ exchange. And I have it marked in red because the NASDAQ exchange is one of 13 exchanges in the US. And I consider this to be a design flaw in the index construction. To me, it's kind of like saying I only want to buy companies headed by CEOs who happen to be born in Amarillo or who are over 6 feet tall. It's an artificial constraint. But I'll come back to that in just a little bit later. Financial companies are excluded, and the index was launched in 1985. The ETF was launched in 1999. 85% of the NASDAQ 100 is in the S&P 500. By weight, it is 46%. There are at least 6 foreign companies in it. Some of the more interesting ones are like ASML, ARM, Linde, the liquid gas company, all very successful, profitable companies, definitely worth owning in my view. And now I come back to the counterpoint to the red, the design flaw, and why I do have NASDAQ 100 based ETFs. And that's because this particular index has outperformed the S&P 500 by about 2% per year since 1999, since inception. That's about 200 basis points. And if you remember the difference between the 100% equity portfolio and the 60-40 portfolio a few slides back, 2 percentage points a year is serious difference in outcomes. So that's one of the reasons I own this, even though I consider this to be a flawed design. It's a heavily concentrated index. 50% are made up by the top 10 holdings. The top 3 are over 24%. Right? That's a feature, not a bug. And it has, I think, 12 sectors, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. There's a small financial sector, even though they don't contain, it is not supposed to contain financial stocks in its design. The main point I want to cover in the holdings is that even 51%, the focus that you see at the 51% information technology is probably understated, right? Because Amazon is not in the IT sector. Neither is Meta, neither is Alphabet. So when you own the NASDAQ 100, you are making a serious bet on technology. In my case, I consider this to be a more growthier focus than the S&P 500, and I do have a certain portion of my portfolio allocated to NASDAQ 100 ETFs, and I'll address that much more when I cover the portfolio in detail, or rather my portfolio in detail. I'll now cover the third and last index. It's the index behind the design for SCHD, a very popular, very large, high quality dividend growth ETF. And this happens to be my single largest holding. What I find very attractive about this index and therefore the ETF is its methodology. So what they do is they first look at all companies with a history of 10 years of dividends, not increasing dividends, just a history of 10 years of dividends. Then they have a minimum market cap cutoff around 500 million and liquidity, trading volume of a minimum of 2 million shares per day. And literally only about 300 companies or so make it through just that first prism, if you will. And then they take the top half by yield. And so the second step is only performed on those that have gone through step 1 and are in the top half. And there are 4 factors that are used to come up with a composite score. They're equally weighted. One is the 5-year dividend growth rate. Second is return on equity, which is net income by equity. And that's a sign of management efficiency. Free cash flow over debt. Free cash flow is cash flow left over after normal capex, right? You can do anything with it as a company. You can give dividends, make acquisitions, those kind of things. And the yield itself. Now, the beauty about the design, and let me just give you one example. Return on equity can be gamed because on the balance sheet, you have debt and equity on the liability side. So you want to game the return on equity, have a lot of debt. But if you do that, the free cash flow to debt metric will catch any inefficiency if you're gaming the system. So what happens is that companies that make it through step 2 will both be somewhat efficient and also be throwing off tremendous amounts of cash. So these are pretty mature, stodgy, well-run, boring companies, which in my case, I want to be the heart, or the base rather, of my portfolio. This is an old graphic, and I don't want you to either take the top holdings or even the yield to heart. What I do want you to understand is conceptually, it's the same type of companies like AbbVie, Pepsi, Coca-Cola, UPS, Merck. This is several months old, but the types of companies are very similar to this. I think Coke is still on the list, so is AbbVie, except I don't think AbbVie is number 1. The provider of this ETF is Charles Schwab. they have a yield that typically fluctuates between 3 to 4%. And because every year the yield, the actual distributions are higher than the previous year, the price keeps going up. So typically what I end up doing is that if it hits 4%, I consider it undervalued and I typically load up, and then I lighten up when it comes to closer to 3% or below 3%. I don't touch my core, the core portion of it, but I might add, 2 to 3 to 4%. And I've done this several times. The distributions are quarterly. The inception date was October 21st, 2011. So it's got a fairly good long-term history. No holding can be more than 4%. It's reconstituted every year and rebalanced every quarter. Now, because of the 4% rule, typically the top 10 holdings, when you sum them up, come very close to 40%. And what happens is every quarter, let's say AbbVie has gone from 4% of the portfolio to 5%, they would sell 1%, take the gains, if you will, and reinvest it into one of the 100 holdings that has not increased. So in a way, what you're doing is constantly taking gains and reinvesting. In other words, selling expensive and buying cheap, which kind of, in my view, gives a little bit of a turbo boost to returns. I consider SCHD to be a counterweight to the S&P 500. Almost all the holdings are within the S&P 500. But if you remember the S&P 500 top holdings, none of these types of companies are anywhere within the top 10 or 20. So these are the stodgier, higher quality, mid-margin type companies, very professionally run and boring as heck, which is what I want for the base of my portfolio. It has, like I said before, increased payout every year since inception, and to the best of my knowledge is the only dividend or dividend growth ETF to have done so. I think it's testimony to the methodology, which I consider absolutely superb. This long-term record more than adequately meets my needs. $10,000 at inception in October 2011 would have quadrupled by the end of last year. Relative to the S&P, it's about a 1.2%, 120 basis points less than the S&P. It's a little bit of a drag. It's pretty significant, but it lowers volatility. So if SCHD is part of my portfolio, it reduces volatility. The advantage of it is that I have to make up less in subsequent years to get back to even versus the S&P 500. So out of the 3 chunks in my portfolio, in the base, SCHD is one of the largest holdings in my base, along with 2 or 3 others, which I will describe when I cover the portfolio. SCHY is the international version of SCHD. Also holds 100 companies, same selection criteria, except that these are ex-US, outside the US, and only in developed markets. So I particularly like that international ETF because as part of my risk management framework, I do not invest in countries with a weak rule of law. And so developed markets pass that threshold. And so I'm very comfortable owning SCHY. SCHY is a very small holding compared to SCHD in my portfolio.